All right, we are still on chapter 9, and we're going to get started on the gross profit method. Okay, so basically, here we're taking a sort of predictable number, the gross profit percentage, and we can apply that to inventories that have been stolen, destroyed. I always think of a fire that may destroy a warehouse, but it may not destroy everything in the warehouse. There might be some things left, but with the gross profit method, we can figure out how much inventory was lost. Okay. So we're going to come down here. I believe that I copied a problem over here. Yes. Okay. Um, so we're going to use this method of finding the gross profit percentage. Remember, I have wrote this out for y'all probably several times. Beginning inventory plus net purchases gives us goods available for sale. Okay. We can switch the ending inventory and the cost of goods sold either way. Okay. We can estimate cost of goods sold or we can estimate ending inventory. Okay. So it's using this plus the sales minus cost of goods sold gives you gross profit. Okay. So I want to come down here and I want to write these out in two separate things because it kind of helps that you have them. All right. So we have our beginning inventory, which is 600,000. And then our purchases. All right. Purchases 1.5 million. Okay. Which gives us goods available for sale of 2.1 million. Okay. Let's come over here and let's write out sales minus cost of goods sold gives us gross profit. Okay. This is on your income statement. Okay. That's at the very top of your income statement if you're a merchandising business. Okay. So they told us that we estimate gross profit to be 40%. So I always like to kind of write this over here. So sales is 100%, then the cost of goods sold will be 60%. Just really basic math right there. Okay. So our sales in this case was 2 million. And if we took the 2 million and multiplied it, we can multiply it times the 40%, which is what they did. Okay. The gross profit would be 800,000. Okay. We can back into that. And now my cost of goods sold is 1.2 million. Okay. I could have took 60% of the 2 million and still gotten the 1.2 million. Okay. So we need this number to come over here and we're going to subtract cost of goods sold of 1.2 million. And then that will give us ending inventory of 900,000. Okay. I like to do them, they did it all in one slide here. I kind of like separating the two because you probably have these two memorized separately, but throwing them all on one slide might be confusing. So I always like breaking them apart. Here is our inventory. And if you remember our T account for inventory, remember this is beginning, purchases gets debited to the inventory, cost of goods sold leaves the inventory, and then that leaves us ending inventory. Okay, so really what we just did in this little equation is really just what we did in the T account for inventory. Okay, so I like it like that. It may not help you if you are okay with the way they did it. They gave you all this information. I don't like it like that, but that's okay. If you do, then there it is. You can work it that way as long as you're getting it right. If you're not getting it right, I'm going to advise you to go back and do it my way. Okay, so real quick, um, this is a, a key to getting good estimates and the reliability of the gross profit ratio is looking back over past experience and what was that. Some of the things that it may not include could not have suspected theft or spoilage, and things like that. Okay, so I'm skipping those. If you want to pause the video and work that one, I'm fine with that. So now we're going to do another method of estimating in the ending inventory. Okay, the previous one we cannot use for year end financial statements. Okay, like gross profit percentage, probably close to like you're trying to maybe file an insurance if the building burned and it's an insurance claim. Okay. So retail inventory method works just a little bit differently. We keep things in our system at the retail, the current selling price. Okay. I know that seems a little crazy. We also have the cost, but we're going to keep it at the retail as well. Okay. So I do like the way they work it over here. I don't have a really easy way of going over to the other page and working it any easier. Okay. So we do start with beginning inventory, cost, and retail. For that, we have net purchases that will give us our goods available for sale in the cost dollars and in the retail dollars. Okay. So we're going to find the percentage cost to retail, and I pulled up my calculator here so I could put those numbers in. If I take the 3, 4, all right, 3, 4, 7, 200, and divide that by 560, then there's my 62%. That is where that 62% came from. Okay. So then we're going to take that cost to retail. So our net sales was 400,000. Our estimated ending inventory at retail is 160. Okay. And we're going to take, I'm sorry, that's at retail. And then we want to figure out cost because remember, we've got it in our system as retail, but that's not what we can do financial statements as. It has to be cost. Okay. So now we have an estimated ending inventory, and now that gives us an estimated cost of goods sold. Okay. All right. Moving right along. Okay. This is one. The gross profit percentage doesn't really take into effect FIFO, LIFO, or average cost. It is very, very basic. This one, the retail inventory method, does give us a little bit more information, and it can be used. It can also be used to estimate any cost of lost, stolen, or destroyed inventory. It's a little bit better. It's a little bit more complicated, not as easy, but it can be a lot more reliable. Okay. Even though they might be using this to estimate, they still need to count inventory at least once a year. Now, there are certain times when they could get away with not counting 100% of the inventory, especially if you have somebody who, well, I'm just going to brag on my husband. He was a very good inventory control manager at Performance Food Group. That was his job. I called that was a glorified bean counter. But he had a crew of guys and ladies that worked up underneath him, and all they did every single day was count inventory. They would rope off 3 or 4 aisles, and they would count those 3 or 4 aisles, make sure what they found on the racks meets and is exactly what they have in their records. If it's not, then they adjust those items so they can have an accurate count. Because then you got salesmen trying to sell stuff, and they're in that same system. Hey, do we have this on hand? Because they might need it to be on hand rather than trying to order it and get it in before a customer needs it. Okay. He did such a great job the first year that he had this job. He kept such good records that he saved them like a lot of money, and they did not have to do a complete 100% count at the end of the year on the inventory. Okay. So if you can provide really good records that you have consistently kept up with them inventory. So basically, the entire warehouse was being counted every 3 months. Okay. 4 times every quarter. That's the way it was set up. And so by the time you've done all of that and you've kept up with good records, you probably don't need as big of a year-end count. Now remember, if you're using periodic, you have to count the ending inventory, okay? Because you have no way of knowing what went out the door, okay? All right. So we have some terminology here with the retail inventory method terminology. We have initial markup. That's the original amount of markup from cost to selling. There is a little example on here, so let's not get bogged down too much into definitions, okay? We may have an additional markup. Then may have a markup cancellation. That's canceling that markup, a markdown, and then a markdown cancellation. So let's come over here. So they give us this original right here, okay? The initial markup goes to 10. Then an additional markup would be 3 to get us to 13, okay? Now they're going to do a markup cancellation of $1 to bring it down to 12, okay? And then your net markup will be $2, okay? All right. Oops. I don't know why it's doing that. All right. So now we are going to do another one of these. We're going to be using, I don't know if this is the same information. It's very similar, but now they've included net markups, net markdowns, and net sales. Okay. Well, we had net sales on the other ones, but we're adding these markups and markdowns. Okay. So this is average cost. And so we have our beginning inventory, which is very similar to the previous one. And then we have our net purchases. And then we have our net markups of 10,000, net markdowns of 8,000. And that gives us goods available for sale for cost and for retail. Notice that the net markups and markdowns were only over here on the retail side. There nothing happened here to cost because that's not what they're selling it. So that's not going to be in there. There's not going to be anything in those blanks ever. All right. So again, we're going to take that 404, divide it by 632,000, and that gives us a cost to retail percentage of 64,000. Okay. So they have the net sales, they have the estimated ending inventory. I'm sorry, ending in retail. And then they take that retail number, multiply it times that percentage to get $126,720. Okay. And then we back into our cost of goods sold, 277,760. Okay. I'm not going to do that. Y'all can work on that when you can pause the video or bring up the PowerPoint slides and um, work that out. Okay, now we're going to do the conventional method. Okay, the big difference here is where the markdowns are. Okay, the markdowns did not go up here. They were up there, and so now your percentage is going to be a little different. Look, it's not a lot different, but it's different enough to make a little bit of difference. Does not to me look like it would be a material difference. Okay, several of y'all are in audit or going to be in audit, so not a material difference. Then that's okay. I mean, you're on the right path if you do this two different ways and you get your percentages are close to each other. Okay, all right. Then now we are going to look at the LIFO retail method. All right. LIFO, remember, means last in, first out. Okay. When there's an increase in the inventory quantity, LIFO results in the ending inventory that will include a beginning and then it'll have another layer. Remember, we did dollar value LIFO back in the previous chapter at the end of intermediate one. Okay. It's very similar to that. Okay. So we're going to start with the LIFO retail method and we have our beginning inventory, purchases, net markups, markdowns. Okay, nothing is going to go in those boxes because the markup and markdowns are only affect the retail side. Okay, so then we have goods available for sale, excluding the beginning inventory right here. Okay, then a goods available for sale, including the beginning. Okay, so you see that 305, 280 is just what this number is right here. If we were to do the math, the 472 only includes these numbers. Okay, So the reason we're doing that is because we're going to find two percentages. Okay. We're going to find the beginning and then we're going to find that this is looks like a month. Okay. Is $64, 64.68%. Okay. So don't look at this. Let's come down here and we are going to look at the beginning inventory of 160 multiplied, that percentage is missing. Okay. To get the cost, okay, because this is our retail, and then the current periods layer, the 198, I'm sorry, that's the total. The current period's 38. Multiply that times that percentage right there. And then we end up with two layers of inventory here. Okay. So just a quick recap. We're going to do some more with that LIFO. So more to come in the next video. But just really quick, a good recap of all the different things we've been doing here. Some of these things you should have learned in the previous chapter. Freight in, when we're doing inventory, when we are the buyer, freight in gets added to the cost of inventory. Okay. Purchase returns is going to decrease the cost and decrease the retail amounts. A purchase discount will only be deducted from the cost amount. There could be abnormal shortages. Okay. That's deducted from both cost and retail. After calculating the cost of retail, we have net sales and then we have normal spoilages. All right. And that is all for this video. We'll pick up in the next one with this dollar value LIFO retail.